MPC's forecasts are exceptionally large at present. The source of these risks and the driver of most of the revisions to our forecast since the May report is overwhelmingly energy prices and the consequences of the actions of Russia. Now, in line with the conventions that we use in the MPC, the baseline projections in the August report are conditioned on wholesale energy prices following their futures curves for the next 6 months and then remaining constant thereafter, the path of bank rate implied by financial markets, and fiscal policy evolving in line with announced government policies. But there are a range of plausible paths for the economy which have CPI inflation and medium-term activity significantly higher or lower than in the baseline projections. And with that in mind, and with the uncertainty in mind that I referred to in the report, we have included several projections for GDP, unemployment and inflation. And a point I would draw out is that the MPC is currently placing less weight on the implications of any single set of conditioning assumptions and projections, choosing to draw more heavily on alternative scenarios as well, and again consistent with the point I made about uncertainty. Now, unlike many recent press conferences, in view of this, I thought it would be helpful, as I go through my opening remarks, to use some charts. So you'll see some charts coming up. We'll also be publishing these charts as well, hopefully they're of use. Most of them, but not quite all of them, by the way, are in the Monetary Policy Report, but not quite all of them. Now, since the May report, as this chart shows, the most significant piece of news has been the further sharp increase in energy prices. You can see it in the orange line, as against the purple line, which is the line from May. And from that, we can see that wholesale gas futures prices for the end of this year, that's right at the hump that you see in the orange line, have nearly doubled since May. Moreover, they're almost 7 times higher than implied by the futures curve a year ago. And that's overwhelmingly a consequence of Russia's restriction of gas supplies to Europe and the risk of further cuts. And you can see when I talked about the conditioning assumption and the way in which we hold the price constant after 6 months, you can see that from the 2 dashed lines that appear on the chart. The consequence of this is that near-term inflationary pressures have intensified significantly. CPI inflation is now expected to peak at just over 13% in Q4 of this year and to remain at very elevated levels throughout much of 2023. The bulk of that further increase reflects higher wholesale prices feeding through to retail energy prices, with a further large rise in the off-gem price gap projected in October. The MPC will take the necessary action to return inflation to the 2% target sustainably in the medium term, in line with its remit. The scale, pace and timing of any further changes in bank rate will reflect the committee's assessment of the economic outlook and inflationary pressures. The committee will be particularly alert to indications of more persistent inflationary pressures and will, if necessary, act forcefully in response. I recognise the significant impact this will have and how difficult the cost of living challenge will continue to be for many people in the United Kingdom. Inflation hits the least well-off hardest. But if we don't act to prevent inflation becoming persistent, the consequences later will be worse, and that will require larger increases in interest rates.